Welcome to the Realtor Raw Perspective, where I take all things real estate and simplify them down in ways that you can understand and apply them towards your personal scenario as you're thinking of maybe someday, one day, buying a house. That's right, so let's get into it. Today, we're talking about interest rates, what they are, how they're going to influence your decisions as you go throughout buying a home. So what is an interest rate? Well, to put it simply, most of the time when someone goes to purchase a house, they'll get some type of financing called a mortgage in order to buy that home. Now, when someone says they'll lend you the money for you to be able to purchase the home, there's usually some type of fee built in, and we refer to that fee as the interest rate. It's usually paid month by month as you go throughout the life of the loan. Okay, so that's your interest rate. Now that we know what it is, let's talk about how it can influence or maybe what some average interest rates are. Maybe even as simple as what's a high interest rate and what's a low interest rate. To know that, let's jump back in time. Back in the early 1800s, when the first bank, called America First Bank, was open, it had an interest rate of 8.1%. Now, that was obviously a long time ago. So let's fast forward to the year 1981. That's 43 years ago from now. In 1981, we saw interest rates peak at between 15 to 20%. That's pretty high. I would call that a high interest rate for sure. Let's keep going though. Into the year 2020, we saw historic lows in the interest rates be as low as 2 to 2.5%. So for perspective, 15 to 20 is pretty high, 2 to 2.5% is pretty low. Those are the extremes that we've seen over the year. But what's an average? Well, according to Freddie Mac, the average mortgage rate over the last 20 years is about 6%. Okay, so 6% is an average mortgage rate. So we know what some highs and what some lows look like, but how is that going to influence the market or my opportunities to buy a home if the mortgage rate is higher or lower? Okay, realize when we have higher mortgage rates, you, the buyers, will not have as much buying power or the ability to spend as much money to purchase a home because that fee is going to be a little higher. So rather than you being able to afford a monthly payment that's bigger, you're going to have a bigger fee, which means you'll be able to afford less. So if interest rates are high, buyers can afford less. If interest rates are low, you have less of those fees, buyers can often afford more. Now that's going to impact a lot of things though. If you have the majority of buyers able to afford less, we've historically seen that appreciation be a lot less as well. We see a little tamer of a market, not as much aggression, not as much homes going up in value quickly, that type of thing. When interest rates are low, we see the home values rise fairly quickly with appreciation because there's more buyers able to afford more and wanting more. You'll also know, if you looked at real estate at all, one of the common things people say is, I'm waiting for interest rates to come down before I purchase my home. I'm waiting for rates to come down. And that's not uncommon. I did the same thing when I bought my home a couple of years ago. I was like, let's wait for interest rates to come down. Here's the problem, and here's what I would be aware of if you were looking to buy a home that you're going to spend more than 2 years in. If you're looking for an investment home, you're going to spend less than 2 years, this probably doesn't apply to you. But if you're looking to live in this home in the long run, here's something I've learned from personal experience and professional experience. My wife and I bought a home in 2022 when interest rates were low. So I got a great interest rate. The problem was competition in the market was high because of those low interest rates. So we didn't get to negotiate much when we bought our home. We pretty much had to buy it as is, couldn't negotiate much for repairs, couldn't get some of our fees paid for by the sellers because there were other buyers competing for that same home. So I locked in our home at a great interest rate, but the problem is now 2 years later, interest rates have gone up. So you think, wow, Robbie, that's a win, good job. But because interest rates have gone up, my home itself has come down in value because buyers can afford less because of the higher interest rate, to the point that currently I've owned the home for over 2 years now, and we're upside down about $50,000 in equity. If I were to sell my home today, before any fees come along, I'd have to pay $50,000 to the bank to be able to sell my home. So why is that way? Why does it work like that? Well, here's why. And here's what I would recommend if you're thinking of buying a home. There's a certain window, the twilight zone, that you can time the market of when those housing prices are pretty level, like they are right now. We haven't seen a ton of appreciation because the interest rates have been high for a while. Housing prices are pretty leveled off for the last year or two, okay? There will be a twilight zone when that interest rate comes down, that if you're sitting at the poker table and you play your cards just right, you'll get a low interest rate and buy the home at a great value and get the best of both worlds. But what happens is, before we even know it, a lot of times, that interest rate comes down far enough and then those housing prices start climbing to compensate for the difference, because now buyers can afford more, and the buyers that have been waiting now see the lower interest rate and are ready to go, and it creates that aggressive market again where homes are selling quickly, you can't negotiate for much, and the housing price, the home price, is higher. Okay, the reason I'm having this conversation with you is if you can time it to where you buy where interest rates are average or a little high, and those home prices have leveled off, and then we jump into the future. Let's say interest rates go higher. Well, you made a great buy because you still have that good interest rate locked in. Let's say interest rates go lower. Well, if interest rates go lower in the future, the price you purchase your home at is locked in. You can't go back to the bank and say, hey, sorry, my home's not worth that much anymore. Give me some money back, please. That is locked in. But you do have the ability to refinance your interest rate. Meaning, hey, interest rates are lower now, Mr. Bankman that gave you my money. I want to lower my interest rate, and they can do that. So if you buy in that zone, kind of like we have right now, where home prices haven't gone crazy, they're pretty leveled off for now. Interest rates haven't changed a lot, they've come down a little bit, but you have more opportunity to negotiate for some of those repairs, try and get some of your fees paid for, more homes on the market as well. That is how you can use that interest rate to your benefit as you're buying a home. Worst case scenario, interest rates go up and you bought at a good time, or interest rates come down and you can refinance it later down the road. A lot of these things in real estate balance out over time. And what I'm seeing in my personal home right now is I've got the great interest rate, but my home value, I'm upside down, and they balanced out. Okay. It's not so much always about what's happening in the market. It's a lot more about your scenario, what you're looking to accomplish, and what you're trying to do with it. That's the good word of the day from the Realtor Rob perspective.